Welcome to Property Analysis with me, Brandon Harbor. I found a property today that I wanted to kind of run through all the numbers with, and I wanted to use it as an example for people that are maybe interested in doing this for themselves. So here's the property, here's some pictures, and I'm going to walk you through the process that I use to kind of decide if this is even worth pursuing any further, and then how that all works. So let's take a peek. So the property here is I found on the MLS. I'm a realtor here in Flagstaff, so this property just came live this morning, and this is in a neat little area, and it's called Country Club. It's a community that has a couple golf courses. It has a pretty low HOA, allows short-term rentals. Generally, a pretty good investment area, but there's always room for some kind of improvement, which is also a good investment area. This property in particular is kind of odd looking. It definitely has maybe less immediate curb appeal. So we're going to talk about this later, but there's a reason why it's at 750, which is I think actually a pretty fair price, and it's probably partly due to that one thing. So let me just show you a couple of the quick pictures so you can be more interested. It is sitting against a golf course. You can see right here, so that's kind of nice. That adds some value. It's not a small lot, which is good. It's about 1/4 of an acre. It definitely has these kind of fun vibes going on, like where you could sit up on the patio, and that's always good. So there's some good atmosphere. There's a 2-car garage. The interior is actually, sorry about my dog. She freaks out at the mailman. The interior is actually in really good shape, considering it's not necessarily perfect, but it is something definitely that you could essentially leave as is right now, and it would start to do well as a rental. One second. Harlow. She's a little overeager. So you see some pictures here, the nice hardwood floors, lots of big open windows, a cool dining area with cool lights. So they've added some new stuff. The kitchen definitely is like a little outdated. I'm not a fan of the blue cabinets or the tile, but again, it's definitely like livable. And you could, if you styled it right, you could probably roll with it as a rental. So let's kind of show you some of these. There's a cool loft in this bedroom. The bathrooms are, again, they're fine. They're not great. Definitely functional. This is a big master. There's this room right here is interesting. It's large enough that you could definitely have 2 beds in here, which is something we'll note later. Like 2 queen size. This bathroom is definitely better, a little updated, nicer showers. This one was updated sometime. And again, that kind of patio vibe, which is really awesome, and it's what people are looking for in a short-term rental. So let me run you through some of the numbers now as we've kind of gotten a peek and feel for this property. Let me show you actually also some of the features. So it's got a 4-bedroom, and it's technically 3.5 bath, I believe. It's 2,000 square feet. So this is like a pretty large, it's like a fairly large or well-equipped house for the size. So let me go now to our next stage. So now what I do is I use this really awesome Bigger Pockets rental report analyzer, and I just put a lot of the information in, which is really the hard part, is figuring out what kind of data to put in here. So you can put in the address, obviously, put in a photo. I like using a photo because when you go look at all of your reports later, it's kind of hard to remember which one was which by just the address. So you could add other features here, like we can add that it's 4 bedrooms. It did say earlier 4-4 and like literally an hour ago, so I wonder if they just updated it. We'll call it 4-3 like they just said. I think it was 2,048 square feet. And it's been updated since 79, excuse me, but it is a 79 build. I don't need a description here. So next, let's go to the purchase price. So the listing price is $750. So I'm just going to assume that for now. And sometimes you can get a discount. Sometimes you have to pay over asking. The market's always hard to guess. So I would definitely try to get it lower. But let's just assume worst case we can't get it any lower. Your purchasing closing costs are always going to be, and this gives you all these little help things, give you a lot of information, but it's like usually 1 to 2%. So I'm kind of rolling it in the middle and calling it more than 1%. So $10,000. And again, that you could be negotiated and covered by the seller, but again, that's a whole nother thing. You can also add in, like, if you're going to rehab the property. Now, since it's like just slightly outdated, if I was going to be buying this for like an Airbnb, I would probably want to update a couple things, like maybe make the lights cooler, repaint a couple things. Not a lot of value, but just like make it a little bit more fresh and a little bit more me. So I'm just assuming we're gonna maybe spend about $10,000, and that's probably high. And I don't think it's gonna much affect the value, but we'll call it, we'll just say it adds $10,000 to the value. This is a little bit of a guesstimate, but to be fair, this property is actually, I believe, underpriced. So I don't think this is unrealistic. But generally, I kind of skip these two because I haven't been looking at rehab properties that much. But you can definitely, there's a whole even rehab analysis that you can, put in the property, tell it what you want to do, and it'll give you an estimate on how much it will cost and how much the ARV is after repair value. That's always really, really helpful. But in general, I feel very confident that this house is actually at least worth already $760, so I don't feel like this is unfair. This is a fun little part you're going to want to add, is how much you expect the property to grow every year. Now, statistically, this still start out at 2%. Statistically, in the US, in the last 20 years, properties have appreciated around 4.7 to 4.4%. So it depends if you look at the last 20 or last 30 years. So I feel like 3 is still a very conservative number. If you really want to kind of just cross your fingers and hope for the best, you can put in 4, you can put in maybe even more. But I would rather, when I'm doing an analysis like this, expect the worst. So I'm going to put in something low like 3. You can even leave it at 2 if you want. Now, I'm not sure how this property will be financed if it was me or somebody else. So I'm just going to put the 20% that it leaves it in as, especially if this is an investment property, it'll probably need at least 15 to 20 to 25%. But if this is just going to be a house that you're going to potentially say is yours, you could do less. But then again, that's kind of a fine line of, illegal if we're going to be using this as a short-term rental. So we'll call it an investment property with 20% down. The interest rates, again, have been fluctuating a lot. So they're kind of in between six, like low 6s to 7s, even sometimes higher. So I'm just going to call it right in the middle. They fluctuate every day. So I've just been using 6.5%. And you could, again, adjust this later. And the loan term is 30 years. Assuming I wouldn't probably do a 15-year ever, but that's up to you. Now, this is the part that gets tricky, is how do you calculate the rental income? So when it comes to rental income, you have a couple options based on essentially the style of the investment that you're going to utilize. So there's what I was just kind of discussing is short-term rental. Short-term is for a couple days, up to blank. People can stay for a long time, but generally it's usually a couple days to a week. That's short-term rental. There's also medium-term rental, which is, maybe a month, maybe 2 months, maybe 3 months, maybe less than a year, but more than a couple days. That's going to be like professionals, maybe traveling nurses, somebody staying in town for a project that they don't want to have a hotel, but they want to have something furnished. You're going to be able to make a little bit more than long-term rent, but you're not going to make quite as much as short-term rent. So it's right in the middle. And then you have long-term rent, which is going to be essentially year plus. And that is going to be your lowest rate. This has a neat little feature where it'll kind of guess the estimated rent. I think this is actually quite accurate. In Flagstaff, rent is expensive. So for a 4-bedroom family-style house on a golf course, it's going to be probably at least $3,000. If you wanted to push the envelope, you could probably get $3,500. I'm going to assume short-term rent. So let me show you how I do that. So there's a cool program called AirDNA. And this program is neat because you can, let me move my face here. I think it's in the way. You can put in the property address in the rentalizer. I do have an account. And you can put in the exact address, how many bedrooms, how many bathrooms, and then how many guests. Now, I mentioned before that one of those rooms was large enough you could probably fit 2 beds in it. So we're going to assume per bedroom, there's going to be at least 2 people, and then in the 1 bedroom, an extra 2 people, because you could have, in theory, kids or something. So we're going to call it max 10 guests. Now, when you're going to do Airbnb, the number of guests is really important. If you can comfortably fit more people in, you're going to get a better rent. So I would say that if you're going to do this property as a short-term rental, you're going to want to maximize how many guests can stay there comfortably. So 10, I feel like, is very fair. When you start getting above 12, it starts to get like, wow, is this a mansion, or like how many bedrooms does this really have? Another rule of thumb is I never want to have more than 5 guests per bedroom. So if you have a 2-bedroom house, it should never have more than 10 guests. That would be like getting uncomfortable. This is well within the limit. This cool AirDNA rentalizer is giving us an estimate of, using a lot of data in town, that says that it thinks that the house could probably get around $382 a night at 53% occupancy, which 50% occupancy is actually quite low. That's, I would feel like that's a conservative number. So that's a good start. If it said like 80% occupancy, I would feel concerned that maybe it was gathering that we could get more than really would be realistic. This is a good conservative threshold. It's guessing $73,600 and annually. So let's go back here. So if you divide, I'm just going to be conservative again. I'll call it $73,000 divided by 12. Gives you around this number, and I round it down again just to be more conservative. I like clean numbers. It was like 6,080 something, but we'll call it 6,050. Once you've decided that income amount on a monthly basis, you put that here, and then you have another fun button here is how much you expect the annual rent to grow every year. So again, this starts out around 2%. I think even this little thing right here tells us that the average is going to be 3.83%. So if you want to leave it at 2, that's awesome. Airbnb is actually different than this number. This is assuming long-term rents. If you want to look at Airbnb data, I think their rent growth is actually much more significant than this. So I feel like, again, 3% is conservative. This is the annoying part, expenses. So on a monthly basis, this is the expenses. I think I originally put this in as a annual number because it's easier. It's not changing it now, but you can go look at the report from, let's see here, the report here in the MLS, and it says that the last year's taxes were $2,281. So you divide that up by 12, you're going to get around 190. The insurance is probably around 2,000. I think you could probably even get as low as 1,600 if you found a good deal for a house like this, but we'll again be conservative and say it's more expensive. So around 2,000 a year is going to be 166 a month. On this part here, this is where this is important. So when you're wanting to estimate for repairs and maintenance, which is going to be kind of like small stuff that's going to creep up all the time. You're going to have vacancy, which is obviously just when people are not there. If you were doing a long-term rent or even medium-term, you're going to want to put something in here. Because I already calculated it based on this number, and it's already assuming we got some kind of occupancy, which is the opposite of vacancy, then we already kind of calculated that in when we were using our income, so I'm not going to add that. However, I think 5% is usually the norm on a long-term rental. Capital expenditures are going to be anything that's like a large item, like a roof or needing to replace the furnace. So they're different than repairs, but it's something you want to start saving for. So we call these kind of like expenses because you're going to take part of the rent and immediately just put it into an account for when you need to use it. It's like a little savings account. So it's not necessarily going to be your immediate profit. So we're going to call 5% here. On long term, you do 5% here. Capital expenditures, you could do 5%. If this house was new, you might lower that a little bit, but 5% is good. And then again on management. So Airbnb generally, if you're going to do short-term rentals, that's going to be a 20% management fee. If you're going to manage this for yourself, though, obviously you're not going to have a management fee. So let's start with that, and we can go back. You're also going to have, if you're doing short-term rentals, you're going to be paying all the utilities. So for electricity in a house like this, if you were living there full time, it might be like 150, 200, considering it's not even occupied all the time. I think 150 is fair. Gas, natural gas, 130, water, sewer, and that kind of ropes in, at least in Flagstaff, trash as well. 200, it could be a little bit more, a little less. HOA fees are $550 a year, so it comes out to $46 a month. And this one I'm just using for internet. And this is probably a little expensive too, but again, I'd rather be conservative. Once you have all those, you're almost done. You can add in this one, annual expense growth. We'll keep it around, average inflation, or hopeful inflation. And then it starts out on this one, it always adds in automatically like 7.5, which is probably, again, a good conservative number. But in the world we live in today, I think, 6% for real estate commissions total is probably pretty accurate. I don't think you need to spend more than that. And it could even be lower. So let's see what this gives us. All right. So it's saying right now, assuming all the numbers we put in there, you're going to be cash flowing around $650 a month. That's good. Positive cash flow is a very good thing. That's not significant, but considering that you're in a town that's going to have really good appreciation on an annual basis, which is one way to make money in real estate, and the fact that you're cash flowing at all is actually pretty impressive. You'll note, though, that if we had tried to do something like, $3,500 or $3,000 for long term, this number would not be working. And there are a couple of changes you'd be making because you would reduce the utilities and all that good stuff, but it still probably wouldn't come out, but we can run those too. So you can kind of scroll through here and see like you would need $170,000 to purchase it. That includes that $10,000 for upgrades, so $160,000 if you don't do that, and all these good things. Now let's say you want to, well, let me show you the rest of this because it's kind of fun. This this is the bottom part, which I like. Let me move myself back over here. Oh, maybe not. Maybe move it up here. The property value is going to slowly over time increase because we added an appreciation rate of 3%. Now this is year 1 through 5, and then it goes into 10 or 5-year increments, and then 10 at the end. So that's why it kind of looks uneven, but it generally would be slowly exponential. So you're going to notice that the value of the property is going to increase. Your equity is the portion of the home that you own. So over time, the property value increases on its own, which is yours, plus the amount that you owe on the house is going to be paid off slowly. So you're seeing that these are going to cross. The cash flow is obviously the number of dollars that we're going to make per month. This is on an annual basis. So you're making about $9,599 a year. These are your mortgage payments. They're not going to change. These are monthly. And then your profit is if sold. You'll notice that it's negative for those first 2 years. And here's why. Because you have to pay a realtor to help you sell it. And so it's not going to have appreciated enough unless you did some significant adding of value that compensated for the real estate fees, that you'd be actually losing money if you sold it right away, because you bought it without necessarily accounting for the real estate fees. And if you sold them immediately, you'd have to pay the realtor, and you're going to be negative, approximately what a realtor's going to get paid from that. The first year is better because it's had like at least 12 months, but it's still not going to be perfect. This is if you sold. So this is only if you sold. But otherwise, after year 2, you're in the clear, and the property is appreciated enough that it's going to compensate for real estate fees, and you're already cash flowing, so that's all that matters. Now, if you decided you wanted to hire a real estate, like a property manager to manage the property, so you don't have to think about anything, you just want checks in the mail. On a normal basis, property managers for short-term rentals charge 20%. So let me just show you what that looks like. If you do 20% on this, you'll be losing $600 a month. So how do you fix that? You'd be obviously needing to make, it was at positive 600-ish, so now it's at negative almost 600. So let's say that you need to make essentially $1,200 more to be in the same position as you were before. Now, if you go back to here, it's renting out at close to $400 a night, and you need $1,200 more, so you need to at least rent for about 3 days extra a month. So 3 days extra a month would bring this occupancy rate to about 63%, if you want to do the math there. And that's actually also still a pretty reasonable number. So I feel like that's still possible. Now, it's not as insured, because you're definitely starting to hope that you can get occupancy to stay high, which is probably how you're going to design your house to be attractive to people. But that definitely still is possible. So overall, I would say this property is actually a pretty good bet. This is something I would definitely consider further. I'm going to remove this back, especially if I'm managing it by myself. It's definitely a good option. And if if I can find ways while managing it by myself to do what we said before and get it rented an extra 3 nights, then you're just going to be making an extra $1,200 a month. The other thing you'll notice is that over time, that cash flow per month, actually, it's easier to see up here. This monthly cash flow over time is going to change. So, after the first year, you're going to be making more. Year 3, year 5, this is assuming expenses are only increasing at 2%, and your rental growth is increasing at a higher rate. So over time, it's going to get even better and better. And if you refinance at any point, and you could get your loan down to say like a 5% rate, which is very possible, then in year 1 or year 2, when you did that, let's see here, you'd already be making a significant amount more. Even in year 1, sorry, it's just a little slow. In year 1, you'd be making almost double monthly. So that mortgage expense, because of this interest rate, is significant. So if you wanted to find a way to buy down the rate, you would do really, really well. That would be a good option. It just might cost more money up front. If you're okay with this total cash needed being higher up front, then yes, your cash flow will be higher. If you have any questions at all, please feel free to reach out. This is just an example of how I do these, but I'm happy to keep showing you and answering questions. There's a lot more to it. There's a lot more ways you could make it more complicated, but that is essentially one way I analyze these, especially if I'm thinking of using it as a short-term rental. All right, we'll talk to you guys soon.